Hi friends, myself Subrata Mukherjee and you are viewing my channel Dr. Subrata Mukherjee Distance Learning in Commerce. I request my viewers to subscribe the channel and to see the playlist section of the channel where I have uploaded lectures on accounts, costing, financial management and management accounting. I have created this channel for the students of commerce who cannot afford private tuition but want to have access to quality education. Please give your valuable comments. Students can communicate with me through email, which I have given in the description box. Today I will discuss another problem on fixed overhead variance, and this is lecture number 7. The other 6 lectures you can see in the playlist section of the channel. Frisk Limited, a manufacturing company operating standard costing system, has a normal capacity of 720 machine hours per day of 25 days a month. The fixed overheads are budgeted rupees 1,08,000 per month. The standard time required to manufacture one unit of production is 4 hours. In June 2021, the company worked 24 days of 630 machine hours per day and produced 3,980 units of output. The actual fixed overheads are rupees 1,06,500. Based on the above information, you are required to calculate fixed overhead variances. We are going to solve the problem on fixed overhead variances. In my previous lecture, I have told you that whenever you are going to calculate a fixed overhead variances, you need to first calculate the following parameters. Number 1 is standard hour, SH. So this is the standard hour SH is the standard hour for actual output. So this is equal to 4 into 3,980 is equal to 15,920 hours. So standard hours is equal to 15,920, and standard hour is calculated for the month of June 2021. Next parameter, so number 1 parameter is standard hour. The next parameter is standard rate, SR. So SR is equal to standard rate, which is calculated as budgeted overhead divided by budgeted hour. So budgeted overhead is given as rupees 1,08,000 and the budgeted hour is 720 into 25. 720 is the hours, budgeted hour per day, and 25 is the number of working days in the month. So this is budgeted number of working days. So this is equal to rupees 6 per hour. The third parameter is calculated as budgeted hour or BH, budgeted hours, which is given as 720 into 25, which is equal to 18,000 hours. The fourth parameter is actual hour, AH, actual hours. So actual hour is given as 24 actual working day in the month of 2021, June 2021, and 630 is the number of hours for each day. So 15,120 is the actual working hours in the month of June 2021. And the fifth parameter is the actual hour into actual rate, which is the actual overhead. Actual overhead. So actual overhead is given as rupees 1,06,500. So 1,06,500 is the actual overhead for the month of June 2021. And the sixth parameter is RBH, which is the revised budgeted hour for actual working days. Actual working RBH is the revised budgeted hours for actual working days. Now this is calculated when there is a calendar variance, that is the budgeted working day and the actual working day differs. Your budgeted working day was 25 days in the month of June 2021, but your actual working days came to 24. So what is the revised budgeted hour for actual working day? So this is calculated at 720 is the number of budgeted hours per day. So for 24 working days, your revised budgeted hour is 17,280. So these are the 6 parameters that you have to calculate whenever you are solving a problem of fixed overhead variances and there is a calendar variance, that is actual working number of working day and the budgeted working day are different. So you need to calculate the 6 parameters. Now we will calculate the fixed overhead variances. So first fixed overhead variance is the fixed overhead cost variance. So fixed overhead cost variance is equal to standard hour into standard rate minus actual hour into actual rate. So standard hour we have calculated as 15,920 hours into rate is 6 rupees and actual overhead is 1,06,500. So this is calculated at 95,520 minus 1,06,500 is equal to rupees 10,980 adverse. Since the actual overhead is more than the standard, so I have written here as A, that is adverse variance. Number second variance is calculated as fixed overhead expenditure variance. Fixed overhead expenditure variance, which is calculated by the formula budgeted hour into standard rate minus actual hours into actual rate. So your budgeted hour you have calculated as 18,000 into 6 minus 1,06,500. So this is 1,08,000 minus 1,06,500 is equal to rupees 1,500 favorable. The third variance is fixed overhead volume variance. Fixed overhead volume variance. This is calculated as standard hour minus budgeted hour into standard rate. So standard hour you have calculated 15,920 minus 18,000 into 6. So this is equal to rupees 12,480 adverse. Now you can calculate fixed overhead cost variance is equal to fixed overhead expenditure variance plus fixed overhead volume variance. So if you add these two, you will get rupees 10,980 adverse. So fixed overhead cost variance is equal to the sum total of fixed overhead expenditure variance and fixed overhead volume variance. Now fixed overhead volume variance has 3 sub-variances. Now you have the fourth variance that we calculate under fixed overhead volume variance is fixed overhead capacity variance. So fixed overhead capacity variance is equal to actual hour minus revised budgeted hour into standard rate. So your actual hour is 15,120 minus revised budgeted hour, that is RBH, is 17,280 into 6. This is calculated at rupees 12,960 adverse. So fixed overhead capacity variance we have calculated as AH minus RBH into SR. Then the fixed overhead efficiency, then fixed overhead calendar variance. So fixed overhead calendar variance is calculated as revised budgeted hour minus budgeted hour into standard rate. So revised budgeted hour you have calculated as 17,280 minus budgeted hour is 18,000 into 6. So fixed overhead calendar variance is equal to 4,320 adverse. And the last one is fixed overhead efficiency variance. So fixed overhead volume variance has three sub-variances. One is fixed overhead capacity variance, next is fixed overhead calendar variance, and the third one is fixed overhead efficiency variance. So fixed overhead efficiency variance is calculated by the formula standard hour minus actual hour into standard rate. So this is equal to 15,920 minus 15,120 into 6. So this is equal to 4,800 favorable. So if you add up these three sub-variances, that is fixed overhead capacity variance, which is calculated at rupees 12,960 adverse, fixed overhead calendar variance is rupees 4,320 adverse, and fixed overhead efficiency variance is rupees 4,800 favorable. So if you add up these three, you will get rupees 12,480 adverse. Thanks for watching the lecture.